Good morning, teacher.
How do you feel today?
Boring.
So let's start our lecture today.
Okay.
So now we will continue the lecture. Last week we talked about the stock market, and before we go into the lecture today, let's review something about last week. The first one is about stock market. As we know, last week, stock market referred to the public markets that exist for ensuring buying and selling stocks that trade on the stock exchange or over the counter. And the stock market is also the place that where investors can buy and sell their ownership of such investable assets. And about the purpose of stock market. As we know, there are two main purposes. The first one is to provide a capital to companies that they can use to fund and expand their business. And the second purpose is about the stock markets can serve to give investors the opportunity to share in the profits that public city trade companies. Okay, the second term about last week is Wall Street. And Wall Street is a street in Lower Manhattan that is the original home of the New York Stock Exchange and the historic headquarters of the largest U.S. brokerage and investment bank. And the term Wall Street is also used as a collective name for a financial and investment communities, which includes stock exchange and large bank, brokerage and security and underwriting firm and big business. And Wall Street is called as a symbol of the U.S. financial markets, which includes the stock market, the bond market, and commodity market, future market, and foreign exchange market. Okay, so I'm just reviewing all the important things that last week that we learned. So now we will come to the topic today about the stock market crash in 1929. And as I requested you last week, you have to research all the important things about this crash. There are four main factors that I told you. The first one is timeline. The second one is causes of this crash. The third one is result. And the final one is the lesson that we learned from this crash. So now anyone can answer my question.
Okay, so I have did a little bit of research about the stock market crash of 1929. It was a 4-day collapse of stock prices that began on October 24. It was the worst decline in U.S. history, and the Dow Jones Industrial Average dropped about 25%, and it lost $30 billion in market value, and that is the equivalent of about $400 billion today. Before the crash, there was a numerous of up and down in the stock market. On 25 March 1929, after the Federal Reserve warning about the excessive speculation along with American economy signs of trouble such as the steel production decline and the consumer were building up with high debts because of the easy credit. A mini crash occurred as investors started to sell stocks at rapid pace, exposing the market's shaky foundation. And despite all these economic trouble signs, stock resumed their advance in June and gains continued almost until early September. On September 3rd, 1929, the Dow Jones Industrial Average increased in value about 10 times higher, peaking at 381.17. However, contrast to the optimism in the market, the financial expert Roger Babson predicted a crash was coming, and that was leading to the decline in optimism and financial gains, and eventually become the start of the Great Crash. So about the crash, the first day of the crash was Black Thursday on October 24th. The Dow opened at 305.85 it immediately fell 11%, signaling a stock market correction. Trading was triple the normal volume. Wall Street bankers feverishly bought shares to prop it up. The strategy worked, but so by the end of the day, the Dow was just down just 2%. On Friday, the positive momentum continued. The Dow rose 1% to 301.22. But however, a short trading day on Saturday removed that gain, and the Dow closed at 298.97. On Black Monday, October 28th, the Dow fell 30% to 260.64, and the next day was Black Tuesday. The Dow fell 12% to 230.07, and panicked investors sold 16 million shares, creating a loss of $14 million in this day alone. And so that is the end of my part.
Market crash in 1929. Then from my research, I came up with the 4 reasons of this accident, which is the first one is excessive investment. And in 1920s, the rapid growth in the bank credit and loans of the US has encouraged people to invest all their monies in the stock market, and some consumers borrow to buy shares, and for that reason companies would likely to borrow more for the expansion. And as people they were so indebted, they are more likely to change their confidence, and many borrowers of loans were exposed in 1929 to debt, so most of them will try to sell those shares to pay their debts. And the second reason is the overconfidence of the consumers and of companies and firms. For the consumers, they because of the rapid growth of the banks, loan could be easily acquired even for the small investor and of the average consumer. So they will not considering about their debts in the future. Along with that, people began to think of the ideas of buy share on the margin, which means that they only had to pay that 10% for the share values. And the share went up, the investor began to make huge amount of money with the margin price, and it may affect all of the banks who let them buy the share. And unexpectedly, when the share price went up, it is not because of the economic fundamentals, but because of the optimism of the investor. For the firms and companies, during the boom investment, many companies tend to produce more goods than their sellings, leads to the overproduction in 1929. When the demand for goods was decreasing, the share price began to fall as the company is struggling to sell the products. And furthermore, the loss of the sales also make the unemployment rate rise significantly. And although the consumers still ignore all of that warning sign and still continue to try to buy the shares. The third reason, which is the agricultural recession. In the 1920s, the Federal Reserve, which is the central bank system of the United States, they also has the same problems, similar to the stock market incident, because the farmer could not keep up with the fast-paced economic environment, and therefore they ran out business, of course. Despite with the help of the advanced technology to increase the production line, people still lost their job because the demand for food at that time is not increased same level with the overproduction of the food supply. So the unemployment rates continue to rise, which could heavily affect the economy. And with the agricultural recession, many banks in rural areas, of course, they had gone bankrupt, and with totally nearly 5,000 banks collapsed at that time between the 1923 and 1930. And the last reason is the inflation. In early 1929, the Federal Reserve has restricted the monetary policy, which the stock has were overpriced at that time, damaging the economy heavily. So to lower the stock price, the interest rate charged on the broker loans has rose significantly, and this might lower the demands to buy share for the investor, but they also lower the economic growth. And the transaction between the brokers and borrowers, they became impossible because the excessively high demand price, the monetary would soon fall apart. And that is my part.
Answering the last question from the previous lesson about what are the influences or impacts on the 1929 stock market crash on international economics, I comes up with some idea, and that is my report about this. And firstly, I think that crash whipped people out. They were forced to sell businesses and cash in their life savings. That's because broken call in their loan when the stock market started falling. People scrambled to find enough money to pay for their margins. They lost faith in Wall Street totally. You can't have healthy economy without confidence in the market. And that crash also destroyed U.S. economy. By July 8th, 1933, the Dow was down to 41.22. That was the 19% loss from its record high close of 381.2 on September 3rd, 1929. And it was the worst bear market in terms of percentage loss in modern US history. The largest one-day percentage gain also occurred during that time. On March 15, 1933, the Dow rose 15.34%, a gain of 8.26 points, to close at 62.1. It took 25 years for the Dow to regain its September 3 high. Between 1935 and 1940, the Dow fluctuated. It reached high of 194 in early 1937 before falling to 98 a year later, which is also fell 42%, and as unemployment rose to 25%. U.S. economic growth decreased 50% and world trade plummeted 65%. That's because price fell 10% a year, a result of deflation. Okay, one of the most I think highlighted events in that period of time may be the Great Depression, and together with the 1929 stock market crash, the Great Depression, and it is the largest financial crisis of the 20th century, and led directly to the Great Depression in Europe. The Great Depression was a collapse of the world trade, and the sharp decline was brought on by a round of tax increase on imported goods and tariff instituted by any nations turning inward, trying to bolster and their own sieging economies. In 1931, Germany industrial production decreased more than 40% and 20% in France and 40% in Britain from 2099 levels. By 1933, unemployment rates in Europe were soaring. Of the available workforce in each country, unemployment rates were 26.3% in Germany and 23.7% in Sweden, 14.1% in Britain and 20.4% in Belgium. The last one is 28.8% in Denmark. And more specifically, I'm going to talk about the real situation in some countries around the world. The first country I want to mention is France. The French economy was fairly unfazed by the crash. The collapse of Wall Street late in 1930, however, triggered by the passage of the Harvey-Smith Tariff Act, brought trouble. Foreign demand for French goods began falling. The value of export fell from 52 billion francs in 1929 to just 20 billion in 1932. And the second country, not really second countries, I mean like the regions, Latin America, those countries, because of the US invested a lot of money into those areas, so the flow of US capital fueling industrial development stopped. And in addition, Latin American nations saw the price for the region raw material dropped sharply as the US and European markets greatly declined, eliminating their need for the material. This trade decline led to the substantial decrease in government revenue. And the last country I want to mention is Australia. Leading up to the Great Depression, Australia was heavily in debt to British banks and relied greatly on wheat export to drive their economy. The collapse of Wall Street in 1930 led to the major drop in government revenue as well as the Australian income. That's covered all of my report, and I hope you are satisfied with my answer.
Since I'm the last one, I think that I will go with the last answer. The last question is that what have we learned about the lesson learned from the 1929 crash? So prepare for this one. I have divided into two parts. The first one is that I will talk about the system, and the second one is that what the people that do the trading and everything learns about the crash. And the first one is that the Securities and Exchange Commissions in 1934, the Securities and Exchange Commission was created to restore the public's trust in capital markets, to oversee the conduct of those markets. Among its many obligations, the SEC attempts to prevent market collapse by requiring transparency in the financial instruments being traded in the financial markets, and also by regulating brokerage firms and self-regulatory regulatory organizations, including the major stock exchange. And it prohibits the certain types of conducts such as insider trading, and enforces law that the govern in financial industry. The second one is the trading time, because after the 1929 stock market crash, trading days were cut back from 6 to 5 days as one way to prevent another meltdown. You see, it took traders and investors time to adjust the shortened trade weeks, but it's now accepted practice to limit days and hours of trading, and it gives trading a weekend break. So these breaks haven't affected overseas stock market yet, and it has many world stock exchanges allow limited after hours trading. That is at the end it will regular the trading day. The next one is that the risk firewall. There's a Computer Weekly profile called the Infamous Risk Firewall. Its software designer it's designed a software to monitor stocks and market activity in real time, so mistakes and fraud capable of triggering stock market crashes are identified immediately. I think that this software is it keeps up with the algorithm trading, and it commonplace with investment firms relying on technology to move trades along safety and risky. Risk firewall can stop automatic trading if block trading patterns or undefined activity threaten to crush the market. Now let's move to the second one, is that the people. So we see that the economy has learned something about the crash. So as well have the people, right? Because they're the trader. So the second part is that, like, what can the people learn about the 1929 stock market crash? So in my opinion, what the people should learn from the crash of 1929 is that they should prepare themselves when there's like another crash come up. So the first one is that they should make a reliable and a strong source of income. They should build and maintain a reliable, strong source of income that makes money, so that it will not be affected by the economy whenever, if anything comes up, such as there's a lot of things that you can do right now, such as doing business online. There was no business online back in 1929, but as now you can see, it is a very popular thing. People should consider choosing the field that it satisfies with everyone's needs, such as fashion, foods, and especially education. That is the field that I think that they will never die and people can make a lot of money out of it. The second one is that after you have a strong source of income, then people should raise their wealth and by following a proper investment plan. Invest the money of people to maintain their wealth and increase to be ahead of the inflation. Investing all the money of one makes into one market is not a good idea. For example, if one invested all of their money into the stock market, then that person will be in trouble if they will be in trouble in the crisis like the stock market. So everyone should always choose a market, like multiple markets properly, and balance their investment using different markets, such as saving money, invest into the currency and the real estate markets, and many more. That is my answer.
So all of you guys did very good job today. So let's take our break before we come to the tutorial.